Welcome to the Deep Dive. We're your shortcut to understanding what really matters from the latest earnings calls.
And today we're diving into Jacob Solutions, ticker J. They just had their fiscal Q3 2025 call this morning, August 5th.
Yeah, held during market hours, and wow, the market reaction was pretty immediate, wasn't it? Really caught people's attention.
It really did. That positive move wasn't just about hitting numbers. It felt like the market was, really buying into the strategy and the quality of these results. Management definitely sounded confident.
Okay, so let's break down what got everyone so excited. What were the key numbers? Because Jacobs, well, they really delivered this quarter.
They certainly did, especially on profit. GAAP EPS came in at $1.56. That's up a massive 136% year over year. Huge surprise there.
136%.
Yeah.
And the adjusted EPS, that gives us a clearer picture of the core business, right?
Exactly. That was also strong. $1.62, up 25% year over year. And importantly, that beat the consensus estimate by 7 cents.
So it's clear.
Yep.
Yeah. And revenue?
Revenue hit $3.03 billion. Now, that was up 5.1% from last year, but it actually missed the consensus slightly.
A slight miss there, but it sounds like the profitability story overshadowed that.
I think so, because adjusted EBITDA hit $314 million, and the margin expanded to 14.1%. That's up 80 basis points year over year.
80 basis points on the margin, that's nearly a full percentage point improvement. That signals some serious efficiency gains.
Definitely. Shows disciplined execution, and they're not just performing now, they're setting up for the future too.
How so? Let's talk backlog.
Record backlog, $22.7 billion. That's up 14% year over year.
$22.7 billion.
Wow.
And the book-to-bill ratio.
Also very healthy, 1.2 times. So for every dollar of work they build, they booked $1.20 in new work. That's growth, not just replacement.
Gives a lot of visibility, doesn't it? And cash flow.
Strong. Free cash flow is $271 million, and they put that cash to work buying back $101 million in stock just this quarter.
Okay, so $101 million this quarter.
Yeah.
That brings the year-to-date buybacks pretty high, right?
Yeah, $653 million repurchased so far this fiscal year. So overall, the headlines look really positive.
Definitely paints a strong picture. But let's dig a bit deeper now. What did management actually say drove these results?
They pointed specifically to strength in life sciences, data centers, energy and power, and water. Those were the main engines this quarter.
Right. And you mentioned the difference between a GAAP and adjusted EPS earlier. Management highlighted that too, didn't they? The small gap.
Yes, they did. And that's important. A smaller gap usually means fewer one-off adjustments, fewer surprises. It points to, higher quality earnings.
Higher quality, meaning more reliable, more reflective of the actual core business performance.
Exactly. It gives you, the investor, more confidence that the underlying business is performing cleanly and sustainably. Less noise in the numbers.
That makes sense. And we saw the margin improvement. Management credited disciplined cost control for hitting those record margins.
Absolutely. Cost control is a big theme. They also emphasized delivering over a 100% free cash flow conversion consistently.
And doing that while still buying back stock and keeping leverage in check. They mentioned a target range, I think.
Yeah, keeping net leverage within their 1.0 to 1.5 times target range. It shows, really solid financial management.
So the balance sheet's in good shape,
Yeah.
supporting growth and returns.
Precisely. They mentioned they've already returned $927 million to shareholders through buybacks and dividends just in the last 3 quarters.
$927 million returned. Okay. So strong quarter, solid finances. How does this translate into their outlook? Did they raise guidance?
They did. That's another strong signal. They raised the full year 2025 adjusted EPS range. It's now $6 to $6.10.
Up from what, previously?
$5.85 to $6.05. So a decent bump mid-year shows confidence.
And the margin outlook, you mentioned the 80 basis point improvement this quarter. What about the full year?
They're now expecting the full year adjusted EBITDA margin to be around 13.9%. That would be a 110 basis point increase year over year.
Wow, 110 basis points. And they attributed that mostly to self-help, meaning internal improvements, not just market conditions.
Yeah, exactly. Things like operational efficiencies, focusing on higher margin projects, cost discipline. It's stuff within their control.
And looking further out to fiscal 26.
They expect revenue growth in 26 to be ahead of 25, and margins should continue to improve as some of their gross margin initiatives really kick in. So solid adjusted EPS growth expected.
And cash flow conversion staying strong.
Yep. Forecasting over 100% free cash flow conversion to continue for the full fiscal year 25.
Okay, so the numbers are strong, guidance is up. Let's connect this to the market and the bigger picture. We saw the stock jump. Why the outperformance recently? Jacobs has beaten the S&P 500 quite significantly over the last 3 months.
Yeah, about 21.6% total return for Jacobs versus 12.3% for the S&P 500. It's pretty telling.
What's driving that, do you think?
I think it really boils down to the market appreciating the payoff from their strategic pivot. Remember last year's spinoff of the CMS and C&I businesses?
Right, the lower margin government services and construction parts.
Exactly. Spinning those off allowed them to really focus on the higher growth, higher margin core. We're seeing that focus pay off now.
In which areas specifically?
Well, areas like life sciences facilities, those big data center campus projects, and the digital work coming through PA Consulting, those are showing double-digit growth.
PA Consulting, that's their strategic consulting arm.
Right. Management strategy is clear. Focus on these high-growth infrastructure and advanced facilities, what they call INAF verticals, plus accelerate PA consulting and integrate digital and AI across everything. It's a conscious reshaping.
And it seems like innovation is a big part of that reshaping. You mentioned data centers. They're doing work with digital twins now.
Yeah, this is really interesting. They're moving beyond just traditional design. They're creating these intelligent, integrated solutions using digital twin technology, especially for AI data centers.
So like virtual replicas of the physical facilities to optimize them.
Exactly. Simulate, optimize, manage complex systems in real time. And the big news here is the new partnership they announced with NVIDIA.
NVIDIA. Okay, tell me more.
They're working together to advance the Omniverse blueprint for creating digital twins of AI factories. Think about optimizing power, cooling, networks for these super power-hungry AI facilities before you build them.
Wow, that sounds foundational.
It could be. They said this could become a reference framework for NVIDIA customers globally. And apparently, inquiries are already coming in.
So Jacobs isn't just an engineering firm in this context. They're more like a tech partner for building out AI infrastructure.
That's the potential shift, yes. It elevates their role significantly.
Are there other big project wins that highlight this shift?
Yeah, a couple stood out. A big digital transformation project with Dallas-Fort Worth Airport using AI and their airport expertise, working with PA Consulting on that one.
Okay.
And also the Myrnis Link project in Australia, which is a major energy interconnector, shows their critical infrastructure chops globally.
And you mentioned they're moving beyond just design and data centers.
Right. Expanding into full program and project delivery. That includes handling the complex power and water needs for these massive facilities.
Moving up the value chain, basically.
Yeah.
Higher margins, stickier relationships.
That's generally the idea, yes. It makes them more of an essential partner.
And all this is happening against a backdrop of some pretty strong macro trends, right? Like infrastructure spending.
Absolutely. You've got the U.S. infrastructure funding, the IIJA or IIG still flowing. Management said only about a third of that money has been spent, so there's a long tail there.
Okay, so plenty more runway from government spending.
Plus the Cheap EPS Act driving semiconductor fab construction and just the massive ongoing demand for hyperscale data centers. These are multi-year tailwinds supporting that huge backlog.
And internally, the lower restructuring costs after the spinoff are helping too.
Definitely. That improves earnings quality. Those costs are set to drop significantly again in fiscal 26, which is another positive structural change.
Any specific catalysts investors should watch for?
Well, the final CHIPS Act grant awards are expected later this year, which could unlock more semiconductor projects. And then the big one is their Investor Day in November.
What are you expecting from the Investor Day?
They're expected to unveil their fiscal 26 margin targets and lay out their capital allocation priorities. That will be key for understanding the longer-term financial trajectory.
Okay, lots of positives.
Yeah.
But what about risks? Anything management flagged or that seems apparent? Skilled labor, maybe? Funding certainty?
Those are always considerations in this industry, yes. Skilled labor availability, potential shifts in government appropriations down the line.
But how are they managing those risks?
Well, their track record on cost control helps. And the diversification of that record backlog is a huge buffer. If one sector slows a bit, strength in others like data centers or life sciences can potentially compensate.
So the overall narrative seems to be shifting, moving away from being seen just as a cyclical contractor.
That's exactly the transition they're aiming for and arguably achieving, becoming this structurally higher margin consulting plus delivery platform.
What does consulting plus delivery platform really mean in practice? How is that different?
It means integrating high-value consulting and advisory services, often digitally enabled, with their traditional project delivery. It's about being involved earlier, offering more strategic input, using tech like AI and digital twins.
So less about just bidding on blueprints, more about being a partner in designing, optimizing, managing the whole life cycle.
Precisely. That typically leads to stickier client relationships, more recurring revenue streams potentially, and importantly, higher margins than just pure engineering or construction work.
And that could justify a higher valuation multiple over time, like a tech-enabled consultant rather than a traditional engineer.
That's the argument, yeah. If the market buys into this transformation and sees the margin profile as structurally higher and the services as more specialized and essential, then yes, a re-rating could be on the cards.
Okay, let's pivot then. This is the deep dive, and it's time for our This Is Not Financial Advice segment. Given everything we've discussed, the strong results, the guidance raise, this strategic shift, what's an outrageous but plausible idea here?
All right. Well, sticking with that theme of transformation and the market maybe not fully appreciating it yet, especially the AI and digital twin angle with NVIDIA, that feels like a potential game changer.
Okay, so how does that translate into an idea?
So here's the outrageous but plausible thought. Consider a long position looking out towards, say, the end of Q1 2026, targeting a price around $165 for Jacobs.
$165. That's a fair bit higher than where it is now, even after today's jump. What makes that outrageous?
The outrageous part is betting that the market has fundamentally mispriced the long-term value of their AI and advanced facilities strategy. It assumes the market will eventually award Jacobs a significantly higher multiple, closer to a tech-enabled consultant, as it grasps the stickiness and high margins of these digital services. It implies a bigger re-rating than current analyst targets might suggest.
And the plausible part. What needs to happen for $165 to be in reach by early 26?
Well, first, that NVIDIA partnership needs to gain real traction, becoming that widely used reference framework we talked about. That could pull through a lot of global business for Jacobs.
Okay, so the NVIDIA partnership delivering tangible results. What else?
Second, the November Investor Day. If they unveil FY26 margin targets that seem conservative, or if they really impress with their long-term vision and capital plans, that could fuel momentum. It allows room for future upside surprises.
Right, under promise and over deliver potential.
Exactly. And third, you have the ongoing share buybacks acting as a support level and signaling management's own confidence. So the plausibility rests on the successful execution of this digital strategy, positive catalysts like the Investor Day, and continued shareholder returns.
So it's really a conviction play on that narrative shift. Jacobs transforming from a cyclical player to a tech-forward, high-margin platform, particularly strong in digital infrastructure.
That's the core idea, yes. Betting the market catches up to that transformation story.
Okay, so wrapping things up, what we've unpacked today really shows a company firing on, well, pretty much all cylinders, doesn't it? Capitalizing on huge trends in AI data centers, life sciences, water infrastructure.
The Q3 results were undeniably strong. Impressive EPS growth, that record backlog, the raised guidance, it all points to significant momentum.
And that strategic pivot into higher margin, digitally enabled services, combined with their financial discipline, seems to be setting them up well for fiscal 26 and beyond.
It really does. Which brings us to the key question for you, the listener. Are we just seeing the start of Jacobs' transformation into this structurally higher margin, tech-forward leader? Or has the recent run-up in the stock price already captured most of that potential upside?
Something to definitely think about. And as always, this discussion is purely for informational purposes. It is absolutely not financial advice. Please do your own research and consider your own investment goals.
We'd love to hear your thoughts on Jacobs and whether you think this transformation story has legs.
Thanks for tuning in to The Deep Dive.